So today's video, we're talking about long-term care life insurance that's purchased or bought with IRA money. So one of the most efficient ways to buy long-term care insurance is to do it with a single premium, one single dump in of money. And we have a whole variety of products available that do just that from a bunch of different companies. And specifically, we have this one that allows you to use IRA money or 401k money that hasn't been taxed yet. And this product originally had a patent on it, or its earlier version. And I've never seen a patent on an insurance product before. And then it's been around so long, the patent expired. And this is a later version of the product. But what basically goes on here is we've created an example of a male 64 and a female 64 of taking $200,000 of their IRA money, putting it into this 10-year income annuity, IRA annuity, that sits side by side with the long-term care life insurance. So these two products are with the same company and they work interchangeably. But this product is an IRA. So you put in the $200,000, there's no taxation right away when the transfer happens. And then you certainly wouldn't want to have $200,000 show up on your tax return in 1 year. That's what would prevent people from buying something like this with IRA money. And that's not what happens, is the money goes in, and then I'll get into the details of it later, but over 10 years, the money is distributed into a 10-pay or a 10-year long-term care life insurance policy. So, and you don't have to use 200,000. You could use less. You could use more. So this is just an example, and we're going to show how the thing works. Now, I want to bring Tom on. I want Tom to talk about like why we're doing this video today, why this is so important.
Yeah, we're doing this video because long-term care is the single most thing that we see that causes the crisis with families. I mean, we deal with a lot of crisis planning when people come in, they're having issues. This by far is the thing that causes the most issues. So we want to plan for long-term care. And this is just one of the ways that we can plan for it using IRA funds, which is where most people, and this might be you, where you have most of your savings or in IRAs, 401ks, money that has not been taxed. So what we want to walk through today is an example of how to reposition those funds and really cover this biggest risk that you face in retirement. I'm going to pull up the show notes here, Hans.
Yeah.
And so we have these at the link below of our video. They're also on our website. Again, we have the board, and we also have just the example that we've pulled out all the important information and put it on the board. But if you want to really get into the details, read more about the policy, we have this example here. I will point out that this is for a couple. This is for a husband and wife who are both 64 years old. If you're younger, you'll get more benefits. If you're older, you'll get less. And so if you're interested, reach out. We'll run you a proposal specific to you and show you sort of what those numbers look like.
Okay. So we write amounts different than this on a lot of people, especially people that are a little older than this. And by the way, this distribution over 10 years counts as minimum distribution. So we have people buy this policy in their 70s or late 60s. Some of them in their late 70s buy this thing, and this takes care of part of their required minimum distribution, this money coming out every year over 10 years. And it is important when you get to retirement to have a mindset to lower the balance in that IRA so that when you pass away, you're not handing a bunch of taxable money over to the next generation where they're going to have big tax incomes. At least that's a goal for most people. And a lot of times that's accomplished through Roth conversions. This has some similarities in the sense that you're slowly chipping away at your money and you're getting something for it, which is long-term care insurance or ultimately life insurance on the back end. So I want to make a couple of points about this. Is the income tax on these $25,000 a year payments is spread over 10 years. And the way most people buy it is They buy the policy, they make the transfer, and then they're going to get a 1099 every year for the 25,000, and they're going to have to come up with the tax on that out of other funds. Now, and we've just estimated at 30% taxes, assuming there's some state taxes. Just as a plug, $7,500 a year is what your income taxes are going to be on the 25,000 as an estimate. And this insurance company will also mess with the numbers with the IRA transfer if we want them to, and we tell them to, so that that taxation will be included in the $25,000 distribution. So in other words, it'll be a $32,000, $33,000 distribution, and then they'll do a tax withholding so that you can really, you'll just be putting in more IRA money to do that. So that'll be one less thing to worry about. But too often, if we get too detailed and too complicated, we lose people. And so I don't really want to do that today. I want to just stay on the big picture here. We're using a chunk of IRA money. We're minimizing or spreading the taxation out over 10 years. And what comes out on the other side through all the inner workings is a pretty significant long-term care policy that's unlimited. So the long-term care benefits that come out of this thing, which can be huge, they could be in the millions, they're tax-free. They're all tax-free to you or your spouse. The life insurance benefit for your children is this thing doesn't pay off on the life insurance when we write this on a couple till the second one dies. So it's a survivorship life insurance policy. But people do buy these things. They pass away soon after, or maybe several years after, and they don't use any long-term care. And the $232,000 is going to be paid tax-free to their beneficiaries. And if they passed away in the first 10 years and there was still money in this IRA annuity, the kids are going to get that too, if both of them pass away. So it's got a lot of benefits in here, and let's just kind of dig in and walk through how this thing pays. I want to bring Tom back on, and we can just kind of show how the process of this works.
Yeah. And so what you, like Hans was saying, is you transfer the 200,000 of IRA funds to One America's the insurance company. It's going into an annuity, which really then is just designed to pay the premium on the life insurance policy. So we sort of understand how that mechanism works. Now you have this long-term care policy that's set up to pay almost $7,000 a month per person, because this is a joint policy, and it pays for life. And so what's really nice about this particular policy is there is never a situation where those long-term care checks are going to stop. And so one spouse could get sick and use it for a couple of years, and then they pass away, and then the second spouse goes on, and then maybe they're healthy for another 5, 10 years, and then they need it. There's just never an end to this policy, which is really nice to cover that risk where there's no end, where most long-term care policies do have an end date where it doesn't last forever. One of the things that to know is there is this life insurance component, this $232,000 of life insurance. And so if neither one of you ever need care, which again is kind of the goal. We'd hope that neither one of you do need care. There's still 232 that's tax-free going to your beneficiaries, presumably your kids or whoever you name, that they get to receive that. And then so it's money that is being repositioned. It's money that's just not gone from your estate at all, but you really get the leverage from the insurance company to provide care, levels of care that you wouldn't be able to do just on your own. If you use a little bit of care, so let's go through an example where between the two of you, you use $100,000 worth of care. They just reduce the death benefit down by $100,000. So you take the 232 minus 100,000. There would still be $132,000 available going to your beneficiaries in that scenario. If you use up the full $232,000 of care, there is no longer any life insurance benefit, but you again have that lifetime coverage for the long-term care piece.
Well, and with so many of the claims now being memory claims in dementia, in people that just gradually can't take care of themselves because they're memory impaired, that those kind of claims go on for a long period of time, and they just as the future comes along, I mean, as we get to the future, it's going to be longer and longer and longer. If lifespans continue, having this unlimited benefit, if there's any way possible to do that, is just important. Now, I want to show you that you look at this and you say, well, $7,000 a month is not enough. I want more than that. Well, if you put in $300,000, you're going to get about $10,500 a month. Or you put in 250, you can do all the math that you mess around with. Maybe you're older than this and you don't like getting an even reduced benefit. Again, the answer to that, put in more money. And we don't take all of somebody's IRA and stuff it in this, and now they've only got long-term care insurance out of their IRA. I mean, we're going to do this kind of thing out of a much larger IRA, and we're just positioning some of the money. Now, what we're showing you here is a couple. This same kind of thing can be covering one person for less than $200,000. So if we have one 64-year-old person, but it won't be half. We could get into that, and then it will be a first to die policy. So we can run the numbers on that. You just give us a call. We're in all 50 states in DC. This policy is not. This policy is not in New York. Yeah, there might be another state or two, like California. This particular version is not available, but there's another version of something similar that's different. So we, Cardinal, are licensed in all 50 states in DC, and we have product of this type available for you. But before we get into the product specifically, we want to do some financial planning for you and just make sure that we're going to get you set up in the right kind of policy.
And I think that brings up a really important point. What you had just mentioned there is we're never taking all of someone's IRA and doing this, right? It's much easier to position this as part of a larger plan because, from our standpoint, being fiduciaries, we need to make sure that we're not taking too much of your money that you might need to live on. And so we need to make sure everything else is set up properly, that you're going to be okay long term from an income standpoint, that you won't need this IRA money to live off of. Once we have solved that piece, that's when this policy really can come in and really protect you from those sort of the largest risks you face of a long-term care situation.
Okay. Within the scope of all the financial planning that we do, I mean, today we're talking about long-term care, and we could set up a long-term care insurance policy that's not a hybrid, doesn't have life insurance, with similar benefits, and you just pay for it. We also could set up a similar long-term care that is a hybrid, that's not using IRA money. If you do have other funds or you wanting to pay for it out of other income or other funds over 10 years, I mean, there's lots of options. We're just showing you today the IRA money. Take a lump of that and make it work for you for the rest of your life. We've talked about utilization and distribution of the 401k IRA. We've talked about income and creating an income, which we have to do to pay for any long-term care insurance or any other insurance. We've got to work your whole financial plan so that you can afford this and without pain. The estate planning, I mean, it's obviously the life insurance piece of this is creating an estate plan. And then we talked about income taxes. So I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.